Hey, what's up guys? This is the Smart Money Technician and welcome to today's video. In today's video, we are talking about the Algorithmic Trinity. The three things that really cause price to move. If you ever see any price movement, they always incorporate these three things. The market maker model. The market is either in a buy model or a sell model. SMT, it can be regular SMT or what we know as sequential SMT. And then the TPD. All these three things work together in harmony, and when they are put together, you have a high probability environment that you can trade from one level to the next level. You know, guys, what would you do without the Smart Money Technician? Because if you go on YouTube, most of the channels are literally giving you cherry-picked setups. For instance, if you're watching a strategy that is out there, they give you a trade example that happened on the 5th of March. And then they give you another example. And that example is happening on the 18th of April. What? Are you kidding me? Do you see how, if you notice and watch these channels, they jump many dates? They don't show you what happens in between those days. What are you not showing me? Are you hiding something from me? Could you be hiding that those days are the days that the strategy lost? Crazy, right? Or for instance, they give you an example in USD JPY. Then suddenly they're giving you an example in oil. Then suddenly they're giving you an example in NASDAQ. They're jumping different asset classes. Why? Is it because they want to show you that it works in other assets as well?
Stop the cap.
Maybe. Or could it be that the setup is cherry-picked to make it look like this is something that is very powerful, but it's not, because I've gone out of my way to backtest a lot of these trading strategies that are out there, and most of them don't work. They suck, most of these strategies. Sorry to say. But what I'm giving you in this video, very, very powerful. So make sure you guys like, comment, and subscribe. Anyways, let's get into the video. So the first thing that I do at the start of the week is that I mark out the highest high and the lowest low in the past 2 weeks. So over here, this is the week that we were going to be trading in this green section. And I look back 2 weeks and I look for the lowest low, marked it there, the highest high, and I marked it there. And I do this for ES and NQ. I don't do it on Dow Jones because I don't intend to trade Dow Jones. I use Dow Jones more so as an indicator to gauge cracks in correlations. So I don't do any technical analysis on Dow Jones. I only do them on NQ and ES. And now we are on the economic calendar. So Monday is a bank holiday. We won't be trading that day. Tuesday, the day after a bank holiday, we also don't trade the day after a bank holiday, so we won't trade Tuesday. Wednesday has FOMC meeting minutes coming in the afternoon session, which will make the morning session choppy, so we will not be trading on Wednesday. So the only days that are going to be really tradable is Thursday and Friday, as you can see. This is where the teachings are going to center around, and this is one of those weeks where it's going to be difficult because the first half of the week is lackluster. Whenever this happens, even sometimes the second half of the week will be difficult because they know that many people are focusing on these days, and you are really going to have to stretch your technical skills when it comes to smart money concepts in order to truly trade these days. Like, you need to be very strict with your rules, strict with risk management, because they know that most people are coming on these days, so they're not going to make these days easy. It does mean that there will be a trade setup, but the trade setup may not be that obvious, and you really need to know your stuff. So the first half of the week, Monday, Tuesday, and Wednesday played out, and what I saw is that a market maker model was building up at the start of the week. So coming into the week, we would have been expecting price to reach the original consolidation. But then on Wednesday, price then traded into a higher time frame daily fair value gap and respected it. Then if we go on the lower time frame, we can see that this is price respecting the fair value gap over here, but then it trades back into the 50% of the range. So we will now be going deeper into the if then day. If you watched the previous videos that I did on this, right, you will see that I say that an if then day is when price trades back intraday into the 50% of the range. So if you take a fib from the low of the current day to the high of the current day, you see price trades back into the 50%, does not then trade any higher and doesn't trade any lower, and we enter into the next trading day. When this happens, we usually call it an if then day, just to recap. But in order to truly have an if then day, there are three criteria, and at least two of these criteria need to be met, right? So one, you want to see price give a true change in the state of delivery. The reason why this over here is a true change in the state of delivery is because you can see over here that price then closes below the opening price of this up close candle. Now, if this down close candle was also an up close candle, then it would be a series of up close candles, and you would need to see price at least close there to be a true change in the state of delivery. But because this bearish candle comes before the bullish candle, we only needed to close below the opening price of this bullish candle for a true change in the state of delivery. The second thing you want to see is to see some kind of SMT that is causing price to give the change in the state of delivery. So over here, there was a small SMT over here. And if you look all the way to the left, there was also a larger SMT. I just did not mark it on this chart, right? So an SMT. And then the last thing is that there's no fair value gap within the day that you're trading that could potentially send price higher. Because what happens is that when price usually retraces into the fair value gap, it respects it and trades higher, right? But now that price trades intraday, it disrespects this fair value gap and not respect it. And if we look further, there's no fair value gap that could potentially send it higher, meaning that this is going to be an if then day because we don't have anything to tell us that we want to continue the bullish bias, and this area that is taking place might be a smart money reversal. This is the premise of an if then day leading to a change in draw on liquidity. So anytime I get a true change in the state of delivery, I always take a step back and I zoom out to see what might be happening. I always check to see if a new market maker model might be forming. So over here, as you can see, we see price consolidating to the side. It then expands, retraces, expands, retraces, and then reaches the level, giving the true change in the state of delivery. And the reason why this approach is one of the best approaches is because it gives you what I call now bias. The bias that is currently in play right now. So if you look over here, right, we were in a large market maker buy model. It doesn't mean that this was not going to play out right now. It just means that this has taken a pause. And what is in current play at the moment is this market maker sell model. And the way we are going to confirm it is using the if then day that I taught. So you take a fib from the low to the high, and when you enter into the new trading day, you want to see a crack and correlation happen in the premium, confirming it, and then you know that, okay, that is the direction the price is going to take. So as you can see, on Thursday, the day that we have the if then daily range being confirmed, this red shaded area is the premium of the range, and you can see during the London session we have a TPD that forms and a 90-minute cycle sequential SMT, but I'm only showing you through the lens of the 1 hour because I'm also trying to show you the TPD that formed, right? So if you don't know what a TPD is, you can check my previous videos. I will link them to this video so that you can go and check them, but the TPD then forms, right? So now I want to show you a secret about the TPD. So we saw the TPD on the 1 hour time frame. You go one time frame lower. So if you were on the 1 hour time frame, you would go to the 15-minute time frame. If you were on the 4 hour time frame, you go to the 1 hour time frame. If you were on the daily, you would go to the 4 hour. Are you getting this? You go one time frame lower, and that's the time frame that you use to spot your reversion level, as explained in the previous video. But on the same time frame, if you see a market maker model accompanying the TPD, it is very high probability. So over here, you need to see at least two things. You need to see a consolidation and a second consolidation before the TPD forms. The first consolidation that takes place is your original consolidation, and the second consolidation that takes place is your first phase accumulation. You need those two things before you can surmise that you are seeing a market maker model forming. So over here, you can see a market maker model form. And one thing you want to notice is that the original consolidation has unsymmetrical lows nested inside of it. So over here, you can see we have a lower low there, while here we have a higher low. Even here we also have a lower low. So these SMT lows are unsymmetrical and they're within the original consolidation. It is a high probability draw on liquidity for price to draw into and trade lower. Whenever you have this, you have a high probability sell scenario. Another thing that you want to notice is that if you look over here, right, Dow Jones was really the weakest asset. You can see it's a big, bold, bearish candle, while here we have this one being an up close candle, and this one, it is a down close candle, but it is not as beefy as Dow Jones. So it shows that Dow Jones is really strong to the downside. And the way that you know that is that when your reversion level forms, the way you know that price is going to respect the reversion levels, as you can see over here, I did not mark the reversion levels in ES or NQ, but I did mark it in Dow Jones because Dow Jones also has a fair value gap before the reversion level. Whenever you have this and you know that Dow Jones is the strongest candle in your direction, and it has a fair value gap, that is usually the asset that is going to respect the reversion level, while the other ones will take out the high of it, giving you the sequential SMT. So over here you can see the sequential SMT that takes place. If I go to the M5, we have the 90-minute cycle sequential SMT is taking place, and then price eventually explodes lower, right? So keeping all these things in mind, the market maker model, the TPD with the sequential SMT, very, very high probability trade that took place during the London session. Anytime I see something like this happening during the London session, I'm not really happy unless I traded the London session, which I don't trade the London session, because I know that the best setup has already taken place for the day, and it took place during the London session. So the New York session might be a bit difficult. I would have preferred to see something like this during the New York session, because if I saw something like this during the New York session, you bet your bottom dollar I am taking part of it. So on Thursday, we get another 90-minute cycle sequential SMT that takes place. The best setup happened in London session, which is unfortunate, but during the New York session, we do get a cracking correlation in the direction that we anticipate. So we can take it. But this session was rough. And the only way that you would have gotten out of it unscathed is if you follow the rules that I've given you. And I've said this in a previous video, and I am saying it again. I said that whenever you have a crack in correlation, can be a TPD or sequential SMT, whenever you have that, and Dow Jones is the strongest asset in your direction, because you always want to trade the asset that is the strongest in your direction. We don't trade Dow Jones because Dow Jones is erratic and sometimes unpredictable. But when Dow Jones is the strongest asset in your direction, you don't want to trade NQ, you want to trade ES. So by following this rule, you would have been safe, and I'm going to show you that. So if you look over here, is this really luck, or are you following the rules? So over here, if you look, the sequential SMT happened. We not focusing on Dow Jones, we don't really focus on Dow Jones. But if you look over here, NASDAQ eventually traded higher, taking out the high. But if you look at ESD, if you zoom deep in there, there's a fair value gap with a breakup structure. You already know what that looks like, so I don't need to show you that. I just want to show you the overall picture of what happened. The market was choppy, chopped around, played around, tested your patience. But if you follow the rules by trading ES instead of NQ, you would have seen price trades but does not get to the high of candle 1 in the fair value gap sequence, and eventually rolls over, hitting 1:3 risk to reward before it eventually reverses for the day. So is it really luck, or are you following the rules that have been given to you? You understand? So by following the rules, selecting the proper asset that you would have traded, you would have gotten out of this choppy session unscathed. You would have even gotten out in your usual 1:3. For those of you who aim 1:2, easily you would have hit in 1:2. And as you can see, the trade eventually reversed against the direction that we were expecting and traded back into the 50% of the range. But this is not an if-then day. And if you listen to what I said earlier on, you will see that I said that a if-then day is when you have a true change in the state of delivery. We do have that here, but this is not accompanied by an SMT. So if you zoom out, you will not see an SMT that took place over here. And at the same time, we do have a fair value gap that is in premium that can send price lower even if price trades back into it. And price did not trade all the way into it, closing it in. So it's not like there's anything that can prevent price from not going lower. There is this fair value gap that's there. So because we didn't have an SMT that supported the trade back into the range, and there is a fair value gap that can potentially send price lower, this is why we will not consider this day an if-then day. We just consider it a regular trade back into the range, forming the low of the day. But tomorrow we will still expect further downside. Okay. And again, you can see that the next day, price on the London session trades into that fair value gap that was in the premium and sends it lower. It also forms a TPD. And if you obviously go one time frame lower, this is the 1 hour time frame, you would go to the 15-minute time frame, you can see that you would see a market make a sell model that forms. So over here we have price consolidating, it expands, it tries to return back into the consolidation again, expands, consolidates to a minor retracement before it reaches that fair value gap that was in the premium, forming the TPD. And if you go to the lower time frame cycles, your own homework, you can go do that and check this for yourself. You'll see what forms over there. So we have a non-sequential SMT confirmed by a 1 hour TPD, and then price eventually trades lower during the session, right? So that is for your homework to go check out for yourself, right? And so what then happened is that a true weak reversal formed on Friday, which caused price to then trade higher. So if you go back to the video where I talk about the true weak reversal, I will link everything to this video so that you can go and check them out. I said that a true weak reversal is when you have two cracks in correlation and one of them being at least on the weekly cycle or higher. So right here we see a regular SMT take place, and then what confirms this regular SMT is a hidden weekly cycle sequential SMT. So this is two cracks in correlations, one being a regular SMT, another one being a sequential SMT, but a hidden one. So if you look at the bodies, the lowest closing price is there, and price closes there, even though it does take out the low, but over here, it fails to close below the lowest close of the previous day, even though it actually does take out the low. So that is a hidden. So if you ignore the wicks and you just look at the bodies, you can see how the bodies diverge over there. Is this a true wick reversal? Yes, it is. Is it an ideal true wick reversal? No. This is why I say that the market this period was low probability, because they don't usually use these kinds of cracks in correlation, hidden sequential SMT, intermarket sequential SMT. They only use those kinds of cracks in correlations when the market is low probability. And it is only those of you that are extremely advanced that will be able to spot these things in real time. You see, as I'm teaching you these things, no doubt some of you will actually become better at me, even though I'm the one who's teaching it to you, because some of you just are more gifted, some of you are more sharper, and you process things much more faster than most people. In order for me to capitalize on something like this, I need to be on my A game, eating healthy, getting enough rest so that my mind is absolutely sharp. But some people are just naturally that way, so they would easily see this happening, and like that they would be able to change their bias and be expecting upside. And if you go back to the previous video, what did I talk about? I said that there are two things that can cause price to change its draw on liquidity. That is the if then day, which we did get over there, and the if then day was then confirmed, which caused price from going bullish to being bearish, and we got a bearish move here, we got a bearish move there, but then we get the true wick reversal. And in the previous video I said that a true wick reversal is another thing that can cause price to change its draw on liquidity. But I needed to add more context to that. So if you look closely over here, you can see this is our original consolidation. If you go to Dow Jones, that same area would be the original consolidation. So whenever you have a scenario when you have one asset hitting the original consolidation, completing its market maker model, while another one is failing to do so, that with the true wick reversal sequence also taking place, so we have two SMTs, that is what causes price to really reverse. And if you go back to the previous video that I mentioned this, right, you will see that that was exactly what was happening. I just forgot to mention that aspect of the original consolidation being taken out in one asset while another one failing. So we have the true wick reversal taking place, the original consolidation in Dow Jones being hit, then we get it being confirmed by a hidden weekly cycle sequential SMT. And if you look very, very closely over here, I'm looking at ES, you can see we have this up close candle, and then after it we have a down close candle. So when price then closes above the opening price of this down close candle right here, that was a true change in the state of delivery, because it has an SMT behind it, and because this was the first up close candle prior to this one. I mean, this was the first down close candle prior to the candle that was an up close candle. So it is the only candle in its series that is down close. So when price closes above it, it is a true change in the state of delivery. So once you have that true change in the state of delivery, as price closes here, you see the next candle opens, rallies down before it trades higher. You go down to the lower time frame. That rally down is actually price trading into a fair value gap that has a breakup structure in your direction. So if I go to the next, you can see over here that you have a break of structure, and as the 10 o'clock candle opened, it traded back into the fair value gap that it had formed, and price easily gave you a 1:3. This would have been a difficult trade for most people that are not that advanced. In fact, it's one of the markets that is low probability. The reason it is low probability is because you have to stretch your mind and really be fast to adjust. Just look at the entire course of the week, right? You will see that the market went from being bullish to being bearish, then bullish again. Usually you will just have the market trade an overall direction for the week before it eventually prints its high or low for the week. But the market had so many turning points this week, and in order to capitalize off of it, you have to be very fast, you have to be sharp, you have to identify the cracking correlation and immediately execute as it is taking place. This is why this type of markets are hard, not because there's no setup, but because they require you to stretch your mind. So in seeing all of this, isn't it wonderful how we can come in every single week and there's a reason why price does what it does? It's not like I'm coming here and I'm teaching some alien concept every single week that is completely different to what I taught in the previous videos. It is the same things, we're just adding some few more things. And I truly do believe from the bottom of my heart that every single one of you has what it takes to be participating in these moves. Just keep it simple. Just keep it simple. All you're doing is you use the economic calendar to select your high probability days, and then you show up on those high probability days during the New York session, which is the time to trade. You wait for a crack in correlation in the direction of the draw on liquidity that you have identified beforehand. And then you use a simple entry technique fair value gap, break of structure in your direction, and ride the move in your direction. If you practice this, you will train your mind to see these things in real time. Are you going to get it wrong sometime? Of course. You're not going to win every single trade, but you are going to win most of your trades. And the more you journal, and the more you learn, and the more you backtest, the better you get at spotting this. Eventually to a point where your accuracy is fairly good and you are able to capitalize off of moves in the marketplace. Are you going to have a 100% win rate? No. But are you going to win most of your trades? Absolutely. This is the foundation to trading. You keep it simple and you follow this protocol, and in the long run, you will be profitable. Thank you very much. Make sure you guys like, comment, and subscribe to the channel. Out.